Hey guys, welcome back to a brand new video. I'm RexFinance, and yesterday I published a pretty polarizing video here on YouTube. And quite frankly, the video got way more attention than I thought it would, and probably more attention than it deserved. But in the video, I discussed my different concerns that I had about Marathon Digital, or ticker symbol MARA, and their potential fraudulent business practices. Now, I got a lot of things right in this video, but I also screwed up. And as this story has developed, those screw-ups have surfaced. And being the guy that published this video yesterday, I feel the need to make this follow-up video and just be honest and transparent with you guys about what I screwed up. So, in today's video, I'm going to be getting into two different things that I messed up on in this video that I published yesterday. But following that, I'm going to dive a little bit deeper into why I'm still concerned about Marathon Digital and its potential demise. It's becoming pretty evident that the company has some explaining to do, and it's probably going to have to change the way it's done some things in the past. Now, this video that I published yesterday, out of the people that rated the video, about 20% hit the dislike button. Now, maybe surprisingly to you, that's actually less than I thought. And that tells me that there's more people out there than I thought that agree with my sentiment and what I have to say about Marathon Digital. Now, if that's you or if it's not you, I want to hear from you in the comment section down below. Explain to me why you're concerned about Marathon Digital, or why you're not concerned, why these things don't bother you. Without further ado, if you guys are new here or returning and not yet subscribed by chance, I would greatly appreciate you hitting that subscribe button down below and hitting that like button. You know, we can agree to disagree and we can still support each other. I'm here, I'm rooting for Marathon shareholders, and I hope you can root for me. Now, let's go ahead and get into the first thing that I really screwed up in this video. Towards the beginning of the video, I started discussing my concerns about the Hardin facility that Marathon owns in Montana. And in particular, I highlighted that the operation had suffered economic losses ever since 2014, and that they couldn't find a buyer for this power plant. And then all of a sudden, Marathon and Beowulf Energy partnered up and brought it back to life and back to operation. Now, people misinterpreted what I was saying, and that's probably on me. This was my first big mess up. I believe that this Hardin facility exists. I believe that this company is mining Bitcoin at its Hardin facility. You're just an idiot if you don't believe that that's the case, because the management team has provided photos and videos several times from this location. But what the issue is, and we're just going to have to see what the SEC finds in its investigation of this facility, is that Marathon very possibly overpaid for this facility. The company might have overstepped the power plant's capabilities and propped up their share price and took advantage of it by raising capital. Now, I don't want to overstep. We have a general idea of what this investigation is going to find, but the bottom line is we really don't know if the investigation is going to find anything. We have a general idea of what it involves, what it might be about, but I'm not going to overstep. I'm not going to over-speculate here. And we're just going to wait to hear back from Marathon and or the SEC about this investigation before forming additional conclusions. But that was my first mistake, because I know a lot of people clicked off the video after they thought I was saying I didn't believe that Marathon was mining Bitcoin at the Hardin facility. But now let's shift gears and get into the biggest mistake that I made. Towards the end of the video, I started discussing the convertible unsecured note that Marathon announced yesterday in a press release. I stated in my video before the official press release came out with all the details about this offering that I felt the interest rate attached to this note would carry 8.5% to 10%, somewhere in that range. And boy, was I wrong. I was way off on this, because Marathon announced today that the interest rate is 1% on the note. And in addition to that, they actually raised an additional $150 million. Instead of the $500 million raise via the note, they raised $650 million. And let me tell you, if I was an investor in Marathon, I'd be jumping up and down about this, because this is a heck of a deal. You're paying 1% on a note to get basically a free $650 million, because that 1% interest is going to be eaten right away by inflation. It's free money for the company, and at the time I made my video yesterday, that information was not made publicly available, and I felt that the interest rate attached to the note would be somewhat more in line with what Argo blockchain had, where their interest rate was 8.75%. Now, I don't know the specifics. I don't know how Marathon was able to accomplish just a 1% interest rate on this note, but good for them. I was very wrong about this. And it's really beneficial to the company now that they have this cash. But this just leads me into what I didn't get wrong and why I'm still very concerned for Marathon Digital. This is concerning to me, and I'll show you this in the video today. But compensation that has been paid out by Marathon Digital to the management team has always been greater than the quarterly revenue that the company is bringing in. Now, you can get away with this for a short amount of time, but trust me, you can't get away with this long. I mentioned it towards the end of last video, but you can build the house of cards higher and higher and higher and higher and higher without it falling. But as soon as one negative catalyst hits, the wind blows, the entire house of cards falls. And unfortunately, unless things change and unless there's some explaining that's done, I think that's probably going to happen. Institutional investors right now, they're not being very smart, in my opinion, with their investment in Marathon Digital because you just can't do that as a company. You cannot pay out more money in compensation than you're bringing in revenue before expenses. You can't operate like that. And what's even more concerning, why this convertible note led me right into this, is because, sure, it's a 1% note, but it's also convertible and it's unsecured. Meaning that there's a very high chance that the entire repayment of this note will be via dilution. It will be by Marathon Blockchain issuing and giving shares to the note holder to pay off the loan and pay the interest on the loan. And this has been a pattern for this company. Shareholders pay the bills. That's the way it is because they don't have the cash flows. In fact, the only cash flows the company has, as far as I'm aware, is the 3% interest they get paid by staking their Bitcoin or loaning their Bitcoin out. They get paid 3% on that, and that's their only active cash flows. Everything else is paid for by the shareholder through dilution because Marathon, to no fault of their own, chooses not to sell their Bitcoin, and that's their only line of business is mining Bitcoin. So they don't have the cash to pay the bill, to pay the compensation, to pay the hosting fees, to pay all these operating expenses. They don't have the cash to do so. So how do they raise the cash? Well, they issue more shares and dilute shareholders, and there's more shares outstanding, which puts negative pressure on the share price. And yes, I know Marathon has performed very, very well, but I just got done saying you can build that house of cards higher and higher and higher and higher, but as soon as one negative catalyst hits, it can be all over and it can blow all over. And eventually, big money is going to care about this because they just have to. You cannot operate as a business like this. So now let me give you hard evidence that this is the case. And we can go straight to Marathon's SEC filings for this, their annual reports. Let's just go ahead and look at the most recent one. In 2020, we can see that $1.2 million was given out in stock-based compensation, and $934,000 was given out in 2019 for stock-based compensation. And if we scroll up and look at the revenue number, well, obviously the revenue outpaces that, which is a good thing. This is what it should look like. But when we look at all of the other items, compensation and related taxes, so these are all of the compensation items, not just the stock-based compensation. So this could be cash bonuses, for example. This amounted to $4.7 million in 2020, which outpaces that revenue number. In 2019, it amounted to $1.5 million, which again outpaced that revenue number. So in 2020, this was the case. In 2019, this was the case. And we know that over the first 9 months of 2021, this has also been the case, where compensation has outweighed the revenues that the company is bringing in. This is not okay. And I'll just show you that this is a pattern for the company. If we go another year back in the annual report for Marathon Digital, we can see in 2019, stock-based compensation was that $934,000, and in 2018, it was $1.4 million. So if we scroll up and look at the revenue numbers, we can see, well, yeah, the revenues outpace that, which is what we should see. But again, when we look at compensation and related taxes, that number, as I've already highlighted for 2019, outweighs the revenue number. And in 2018, it still outweighs that revenue number, and this is just not okay. This is a pattern for the company. This is what's going to have to change because you cannot operate a public company like this. This is what you call an insider enrichment scheme. That's what it is. The insiders are getting rich while their company on paper is losing money because of the bonuses they're giving themselves. Now, I'm all for stock-based compensation and incentive-based compensation, but this is too much. If this was a one-time thing, sure, I'd get past it. But this is just a pattern. And I'll go back another year in the annual reports and we'll see just the same thing. Stock-based compensation in 2017 was $1.976 million. If we scroll up to the revenue numbers, we'll see that the revenue was $500,000. And if we take into consideration all the other compensation and related taxes, in 2018, they had $4.36 million paid out for compensation and related taxes. In relation to the $520,000 of revenue they brought in, this is not okay, and this is going to have to change, and I hope the management team addresses this, not just for my sake, but for you guys' sake, that might be shareholders, for the industry's sake, because the crypto industry needs credibility. It needs credibility, and this isn't giving the industry any credibility when all it is an insider enrichment scheme. This has to change. And this is what I'm so worried about. This is why I believe that I can call Marathon a fraudulent company, because the company appears to be in place to enrich the management team and not much else. So that's my concern. I hope things change, but I'm going to leave this video here. I hope I addressed some of the issues that I had with last video, and I hope I explained myself even better in today's video towards the end. And with that, if you guys enjoyed, I would greatly appreciate you hitting that like button down below. And again, if you guys are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button. And with that, I hope you have a great rest of your day. I'll be back with a brand new video later this week. Peace out.